Well, even though the Dow ended the day lower, overall it was another record day on Wall Street. The Nasdaq closing in and yet another new high. It's now up nearly 34% in 12 months. But it's not just stocks getting bought this year. Bonds, they've also caught a bid recently, and because of the buyers, yields have moved down. The 10-year at 1.73%. Let's talk more about all of this and maybe a little about crypto with Tom Lee, co-founder and the head of research at Fundstrat Global Advisors. Stocks up, bonds up, gold's up, real estate's up. How? These are great questions.
Yes. I think it shows that people may have owned too much cash in the past 2 years. And now we're starting to
somebody
see
had a bunch of cash sitting around, a couple trillion.
That's right. And
the Federal Reserve.
And it's not just central banks. I actually think there's money flowing into the U.S. So I think when we see the tick data, we're probably going to see foreign inflows into risky assets in the U.S. as well. So I think the story this year looks a lot like risk premia shrinking, which means continuation of last year where PE multiples keep expanding.
Is there a way to quantify, and I know we've talked about it, and Guy Adami's been talking about it, and we've all been talking about it, any way to quantify how much of this run is central bank driven? If central banks weren't easing, let's say the Fed kept rates where they were, just reversed the December 2018 cut, but did nothing else, where would the market be?
I think markets would stall. I mean, maybe not because the fundamental flows would stall, but I think perception would change, and I think people would pause to see how things would unfold, and therefore stocks would stall.
The growth of the balance sheet, I mean, it's historic. It's going to be by April, the balance sheet of the Fed will be larger than it's ever been in history in an environment where, I mean, according to people in the administration, it's the best economy ever. Why are we taking emergency measures in a situation where what's the emergency?
Yeah. I mean, I sympathize with that view because, at this point in the expansion, government debt should be shrinking. But I think there are problems outside the U.S., so I think the central bank is still carrying the weight of the world. And I think that's why we have the accommodation. And for the moment, it is good for risky assets, which, again, is good for the economy.
So, but in terms of asset allocation, Tom, is the thing to do here, it seems like the mega caps are catching this large basket of money coming in. Do you stay in these trades that have worked that are obviously, in some cases, Google's not a difficult valuation to get, Apple's not a terrible valuation relative to itself, it might be. But how do you play this, or do you go into underperformers because they have underperformed?
Yeah, I think there's sort of two themes you can play this year. One is the PMIs recover, and so you want to be long the tech, the industrials, really that cyclical trade, and really led by tech. But the other is risk premia is coming down. Equity risk premia to bonds is still really elevated, and you want to buy stocks that have high risk premia. Like healthcare is actually the cheapest sector today on that basis.
So, Tom, back to the bonds, though, for a second. I mean, last summer when we saw the 210 yield invert, well, obviously the Fed fixed that sort of thing. That was kind of an issue. And we saw the 10-year Treasury go down to, multi-year lows, 145. You had this bounce. It could not get through 2. Heading back down, it's actually breaking the uptrend that it had been in since the summer. And if you were to see that yield curve kind of flatten again, are we going to have those same sorts of concerns, especially after all that easy money that we've had in the last 6 months or so? Is it really speaking to just really that the growth is not there? And then when you talk about these risk premiums, that maybe they're just getting a little too elevated?
Yeah. I mean, if the curve flattens again or inverts, it's bad. And so stocks are going to tumble or have some stumbles. But I'm not surprised yields are kind of falling because, with coronavirus, I would imagine people are going to do some risk off, and I think people have made a lot of money last year. So I think I'm kind of more attributing this to sort of, potential risk because this could be 2003 SARS again.
When you talk about industrials, are you looking for U.S.-centric or U.S.-contained industrials as opposed to multinationals?
Yeah, because I think it makes sense that you should see some short-term effect from the quarantines and the slowing trade. So, I mean, I think basic materials maybe hit harder. But with industrials, they tend to do well when the PMIs recover. So we're anticipating a recovery in the ISM above 50. And so guys like Dover and, maybe domestic, less aerospace, but yeah.
We talked about Dover last week. Remember that?
Sure we did.
The all-time high going back to you got to go back to Fonzie.
Wow.
To the last time that Dover.
Which is usually where people go back to.
By the way, where is inflation? The Fed is pumping money at the problem. We still don't have real inflation above 2%. We haven't forever. Are they going to keep going until they get that inflation target? Because at some point, you either just give up or you're just going to double down.
Yeah. I mean, I would say anchored inflation expectations are going to take a long time for people to start to think about inflation. It should start to rise this year because labor markets are tightening. So I think for 2020, it's less of a part of the calculus for investors, but which means the Fed, might be easy longer than we need to be. But that might be a problem in 2021.
Quickly, still bullish on Bitcoin?
Yeah, 2020 should be great for Bitcoin because you got, number one, the halvening happening, the block reward for miners getting cut in half. That's a good supply-demand change. I think last year the White House killed the Bitcoin rally by with their opposition, but with the presidential election cycle underway, it's not going to be in the headlines, and that's bullish for Bitcoin. And then with geopolitical tensions in the Middle East, I think that's good for crypto. So should be a lot of tailwinds. We're getting a lot more interest in it as well from our clients.
You are. You're starting to see more real interest.
Yes, a lot.
All right, Tom Lee of Fundstrat. Tom, it was a real pleasure.
Yeah, great to see you.
All right, Guy Adami, people are going to criticize you or everybody else for saying, oh, it's the Federal Reserve. It is the Federal Reserve, but at the same time, it's just benefited people. And at some point, even the biggest Fed haters in the world, the Jekyll Island rejectors, have to at some point acknowledge that and maybe cave in and say, you know what, forget it.
Can I add to that?
No,
the second part of that question is, what did you think of Chuck on Happy Days?
You know what? He had a brief stint, Chuck. Yeah. He played basketball. I think he went off to college. And then the people realized that, you don't need Chuck and Richie. Give it to Richie and let Joni play a minor role. That's what I think. Number one. Number two, listen, I get it. I say it all the time. It doesn't matter the reasons your stocks go higher. The money in your account is as real as it was if it was going up for the quote-unquote right reasons. But at what cost? And to answer your question about where's inflation, well, it's in everything we talk about every night because asset inflation is absolutely here. I'm paying for education. I don't know if you folks have seen that. Healthcare is through the roof, and technology is the most deflationary force in history, and we're dealing with it now. So the Fed's fighting the wrong enemy right now. Inflation is everywhere except where they look for it, in my opinion.
I'll just say one thing. Tom Lee agreed with me. If the 10-year Treasury yield breaks that double bottom low from 2016 to last summer, I think alarm bells are going to go off in risk assets.
If we get close to that, Dan, we'll have had alarm bells. I mean, you're talking about 140, 136 to 140.
Okay, not far, Tim. I mean, when it broke 2% last year, it went straight back to that low, and it held. And it only held because the Fed got in there and they cut rates 3 consecutive meetings starting in July 31st, and then they started buying, $100 billion a month in treasuries.
I share your frustration, and I'm not saying that it couldn't happen. I'm telling you, though, if we start to challenge even 150, we have some structural issues that are not here and now. And I realize that we all believe that the Fed has greased the rails here. And certainly the coronavirus could be doing such to at least put headwinds into the global growth forecast. But 135 to 140 tells you we've got much bigger problems.